Good morning, good afternoon, good evening, and welcome, depending where you are on the planet. Welcome to the Bull versus Bear Trade Day webinar, and here on Monday, 20th of September. Steve Mully on the call. Welcome, everyone. I'm running a little behind today, so I'm just opening up tabs now, so you can see a little bit of my process as I go through and look at how I set up, actually. So I'm a little behind. So my apologies for that. But then you can see, how I decide what to look at and what not to look at as we go through. I've opened up some of the tabs in here, but I haven't quite got there yet. So please bear with me as we go through this morning. So we'll go through our usual regular run through in here today, which will include the extra bit of looking at the bigger picture shape of the week, what I like to call the shape of the week. So take a look at what we've got coming up for the whole of the week. So it gives us an idea, even as day traders, trade day, we're day trading, but even as day traders, it's good to have an understanding of what's coming up potentially throughout the week, as well as obviously what's going to be coming up today. But I mean, giving us, if we look at what's coming up through the week, then it can give us an idea of where we might see some higher volatility. If we're expecting higher volatility maybe later in the week, then that's maybe a reason for us to see a less volatility maybe earlier in the week. So hence going through a bigger picture. I think it's just good practice to get into. So we're going to do that. We'll take a look at the bigger picture of the week. Obviously, focusing on anything particularly we've got today, and then looking at all the major macro economic and fundamental articles from the major news wires, focusing in on Bloomberg and Reuters. Also take a look at Forex Live, take a look at the Fed tool, and we'll take a look at some charts. I say I'm running a little behind in here today as on my setup, so I'll just show you a little bit of my process as I go through, although I've got most of the tabs open for Bloomberg, but still looking at Reuters at the moment. So let's take a look first of all. I'm going to do a bigger picture at the roundup. So this is, you can get this from the dashboard. So if you go to the dashboard, I can't go back to the dashboard and show you where this is now, because if I do, I'm playing in that, and we'll get a horrible feedback loop on the sound. So if you go to the members area, and so not the dashboard, into the trading room, you go in the members area, and if you go there, then you will see in there where the technical analysis, where the market reports, where I upload the market reports every day that you can download. So you can take a look at those if you haven't looked at those as well. But if you go take a look at where the market downloads are, they're also usually over the weekend. Well, it is over the weekend, usually Saturday, Sunday. Usually on the Sunday, I upload this, what you see on your screens now, which is like the trade day macroeconomic recap and outlook. So this is looking back and looking forward. So what was the theme last week? Well, last week, really, it was all about the Fed. All right, so the Fed hiked, as we expected, 75. But they had certainly a look for a more hawkish tone than anticipated, looking for a peak of up to 4.5% and staying elevated with rates. And Chairman Powell said assisted with downbeat comments from Powell, said no one knows whether this process of raising rates will lead to a recession, or if so, how significant that recession would be. So, first time he's really kind of acknowledged, the risk of the recessions. Also last week, the other two events in here, one is which has come to the fore this morning, has been the fact that the Bank of Japan intervened in currency markets. So we've got super strong US dollar, as we know. The dollar's been super strong throughout 2022, and it's only increased. That is because of obviously the very, very hawkish tone, the more aggressive tone coming from the central bank, from the Fed, and also from the point of view that if we're in a risk-off scenario, which we are at the moment, risky assets getting hit on the downside, if we've got recessions coming globally, where do you want your money? Where you more likely to place it? Where you're going to put it in sort of safe haven, which is the dollar. Now, often the yen is often seen as that safe haven, but because of the interest rate differentials, you're not going to earn anything by putting your money in Japan, right? As a safe haven, because interest rates haven't moved. They're still super low. They're still sub 0%. Where are interest rates going elsewhere on the planet, and particularly in the US, they're accelerating higher. So the dollar has become the currency of choice this year. And so on Thursday last week, we saw intervention, the weakness in the Japanese yen that we've seen. Obviously, that's not good in Japan. You're going to get more imported inflation, okay, if you have a weakened currency, okay. So for them, that's certainly a negative. So what we've seen in here was intervention in the currency market after dollar yen went above 145. The more significant thing really that's really come to fore this morning. So the pound got hit. So the dollar's been strengthened anyway, but the pound versus dollar. But it's not just the pound versus the dollar. It's the pound against everything. The pound is getting smashed against everything. Got smashed last week, and this was because we saw a UK mini budget. So this is kind of the program where they set taxes and they set spending. And we've had a big a spending package, support package to help with the energy crisis. That's been in the pipeline anyway over the last few weeks. And we had more details on that over the last week. But also on Friday, we saw tax cuts come through. Okay, so they cut taxes, they cancelled some other taxes that were due to rise, okay, as well. Now that has been taken by the market as a massive negative. You know, you're increasing spending and cutting taxes, massive budget deficit, okay, and that's seen as a massive problem in here. That is that sustainable? Is that actually going to create more problems rather than solving the problems, okay? And it's very much a populist. You know, there's a lot of so it's the new Conservative government. Okay, we have a new Prime Minister from the last 2-3 weeks. Just before the Queen died, the new Prime Minister was put in place, Liz Truss. And with her new government in here, we've seen this populist kind of move, to try and basically obviously they're trying to, in their view, they're trying to also help out with the crisis we've got with the energy, and also to stimulate the economy. But obviously, the Bank of England are hiking rates to try and get inflation under control. So this has been viewed as the market as a negative, not sustainable, and obviously further borrowing down the line, increased borrowing at increased higher interest rates. And all of that has seen the pound, no confidence in the pound. And the pound was smashed on Friday. But then this morning we had a flash crash. So the dollar strengthened across the board. We had a flash crash with the dollar strengthened really across the board. And the pound got absolutely annihilated to an all-time low against the dollar. Okay, nearly went down to parity with the dollar. For most of my life, the pound dollar has been between 1 and 2, right? 1.0000 and 2.0000, right? Most of the time, it's been spent between 1.4 and 1.6, around 1.5, right in the middle of that. More recently with dollar strength and with pound weakness, it's been sat down to the bottom end of that, around 125, 120. But it's been plunging more recently. And then this morning, we saw a super aggressive negative move for the pound. If I go and show you on one of the charts in here where we've got cable. So here it was in here. So this is one of the charts that you can see in here. So this is Friday, but then this morning went bash, smashed down from the 108, 109 area all the way down here. I mean, on this chart, it's got the low at 103.50 something. In some charts, I've seen it below 103 down into the 102s, down to, and then back up to 108 now. So it's had a roller coaster ride of basically 5-6 cents lower and 5-6 cents. So it's like nearly 5% down and 5% back up again this morning. It's been a massive roller coaster, and not just the pound. The euro's seen that as well. The euro smashed lower in here. The euro's obviously been selling off anyway. Now this is this is dollar strength. Obviously, a lot of this is to do with dollar strength. But if you go and look at, I think I've got euro versus pound in here. Yeah. So if you look at euro versus pound, that was this morning for you and Friday, and then this morning for the euro versus the pound. So the euro versus the pound, and if I take this out to like a weekly chart, you can see smashing higher in here, the euro versus the pound. So it's not just in here. It's not just the fact that we've seen the pound weakening, against the dollar. This is not just dollar strength. This is pound weakness as well because of this no belief in here in the mini budget that was put through, these extra tax cuts and this extra spending, okay, and it's really riled markets. So this is, and the reason I know I'm going on about this, and you guys are probably thinking, why is he going? He's just this UK guy going on about the pound. His holidays to America are going to be more expensive. Yeah, okay. Well, it's not that reason, although that is an impact on me, and it means I probably won't be coming stateside for a while because all of a sudden it's got very, very expensive. The reason I'm talking about it, guys, is this is a big risk-off play, right? It's a massive risk-off play. It's a massive rush into the dollar. It's a massive rejection of this populist. And I think we have to really watch that. We only had the Bank of Japan intervening in the currency markets on Thursday. Now, Friday, there's talk now, right? So I'll just run through some of the headlines in here. So you can see it's all over here. Look, global risk assets tumble as pressure on UK mounts, right? Okay, it's taking centre stage in here. That's the headline on Bloomberg this morning, right? If we go in here, look, global risk assets tumble as pressure on UK mount. Oh, it's the same one. Pound crashes, gilt yields. Gilts are UK bonds, okay, like Treasury bonds, okay. Gilt yields jump. There's been a massive spike higher in gilt yields as well, right? So it's selling off of gilts because there's no trust in those either. And then dollar climbs yet another record, okay? And US futures are down. The US futures equities are down on the back of this because it's a move out of risk into a risk-off mode, okay? UK market sell off slams gilts pound, piling pressure on the Bank of England, okay? Currency funds talk of emergency central bank action, talking about potentially raising interest rates. They only raised interest rates, remember, in the last week or so in here, and now talk of another rise in interest rates in here, maybe, or potentially even going to be intervention in the currency market. Unlikely, but who knows, right? Down below 103.50, as I say in here. And so all the headlines are here. Crisis levels risk loom in Asia as major currencies crack. Yeah, heavyweights yen, yuan, both tumble as Fed hikes boost dollar. So it's not just the pound. Okay, as I said, it's elsewhere. We've spoken about the yen, the Chinese yuan as well. Okay, rapid slide creates dead weight for other Asia currencies. So it's not just here, right? There's concerns. This is like a contagion effect, right? The dollar's too strong. I wouldn't be surprised if at some point we see a concerted multilateral. Okay, so far we've seen unilateral, right? Unilateral, we've seen the BOJ come in and defend the yen. Okay, I wouldn't be surprised if we see a multilateral a move by central banks globally to defend their currencies, but more what we're really going to see is to see selling of dollars, okay? And what it would be really important if the Fed got involved as well, because even though it's positive, there's some upsides for the US having a strong currency, there are plenty of downsides. It's no good the US having a strong currency and all the rest of the world is suffering, right? They're all going to get imported inflation, right? There's plenty of negatives as well, potentially, from having the strong currency for the global economy. So we could see a multilateral, okay, a central bank intervention in currency markets. So don't be surprised to see that coming. You're almost certainly going to get unilateral moves as well, right? So this, say, talk here of Bank of England getting involved, and it's not going to be just here, right? We could see it elsewhere. You could see the ECB, the euro getting smashed as well, right? So there's lots of, and then it's contagion. It's elsewhere. So as I say, stock futures are only slightly down. They're obviously significantly down again on Friday, but you've got oil falling as well, right? Wrecking ball dollar piles on commodity losses. Remember, a strong dollar, is negative for commodity prices. So that's pushing commodities down. Now you might say, well, that's good, right? Lower oil, lower energy costs is kind of potentially helping. Yeah. But then who knows what OPEC could potentially do on the back of that? Do they want oil back higher? Okay. So US currency rallies to fresh record as recession concerns rise. So it's all piling into the dollar. So look, G7, another headline, G7 currency volatility surpasses emerging market peers. So the G7 currencies, the major global currencies, right, in G7, the volatility in their currencies is higher than in the emerging market space, right? So look, 1 month implied volatility. So this is the volatility on the pound climbed above that of the Brazilian real and the Polish zloty. Okay, so this is not the norm. Okay, developed market currency swings surpass emerging markets in here, and you can see in here in the graph. And more stuff. UK bonds plunge. Sell off in the UK bonds. That's the gilts. After traders turbocharge bets on a Bank of England hikes. Okay, so potentially in here. So let's remember, bonds going lower equals yields going higher. So potentially a more aggressive rate hikes coming down the line. Potentially even just to defend the pound. Okay, so all of this going on this morning. Again, Bank of England limited options as pound caught in crisis. The Bank of England will be forced to step in if gilt yields keep surging. Right. So so there's lots going on. And in here, I'm just going to quickly see a bit of the process now. I'm going to see what I haven't actually looked at. So pound plunge, latest ill omen as market stress rises. Same highlight there. What else do we have in here? So usually what I do in here, guys, I go through this page, the front page of Reuters. I then tend to take a look at European markets, what's going on in here. Okay, so look, UK short dated yields extend slump yields highest since 2008. So UK PM Liz Trust, we don't comment on market moves. Well, they're going to have to at some point potentially. UK gilts on track for biggest loss since 1957, the biggest daily loss in gilts since 1957. Okay, and then and then you see in here negatives in here. FTSE getting particularly beaten up as well. You know, no faith in the FTSE 100. That's the UK index. In here on the back of that, but you can see also European bourses, the German and French in here, the DAX and the CAC also lower. Let's take a look at what's going on for US markets on the headlines here as well. So you futures shackled by rate hike recession worries. Again, you know, futures in here lower in here this morning. And what else we have? Inflation fight can avoid deep pain. Atlanta Fed. So that's not much in here on the US markets. It's all been about really in the currency markets this morning. And you can see in here, though, they're getting dragged down. Okay, they're down this morning. This is on the back of it. Obviously, the fact that we got smashed on Friday didn't help, right? So this is a follow through from Friday, but not only the follow through from Friday in here, we're also seeing a more negative tone in here being driven by this risk off move that's been coming out of the FX markets. With broad dollar strength, but really being exacerbated by this big sell-off in the pound in here. And if we go to Forex Live in here, look, Bank of England reported expected to make a statement today. Okay, so Sky News reporting a statement out of the Bank of England, even though the government has said they're not going to make a statement. We don't comment on market moves in here. Dollar stays in control. A sell everything move persists, and it is a sell everything move. That's what we're seeing. Japanese intervention, FX intervention, last week estimated being about $3.6 trillion of yen. They came in. Okay. And cable, as obviously, is only down about 1% this morning, having got smashed, obviously, earlier today. I'll go back to the calendar in a minute, guys. Yeah. But in here, if we're looking forward now, obviously we've had the rate hike, looking forward to the next hike in here. Pretty much nailed on in here for another 75. Remember, at 300 to 325 is the current rate. 375 to 400 being priced in for November, with only a slight chance of only a 50 basis point hike. But remember in here now, if we look out to year end, we're going up to the peak 425, 450 at year end, but then going higher to 450, 475 into the beginning of next year. This is where we hit peak rates now, and that's what the Fed basically told us. You know, that's where we're going to be going up to 450 to 475 by February. And then if we look out 450, 475 in here, maybe an outside chance of a bit higher. If we go through into next year for even a risk of up to 475 to 5% next into the middle of next year. 475 to 5%. So the market now pricing in even more than the Fed are telling us. Remember, the Fed are looking at, from the dot plot chart from last week, the forecast, we're looking at more likely peak at 450. The market's actually pricing in risk of it being higher than that. And then the other thing, if you go through to the end of next year, look, it's still at 450, 475. So it's going up to those kind of areas, either up to 4.5% to maybe as high as 5%, going at 470, 450, 475 in here, going into the early to middle part of next year and staying that elevated level through year end. No rate cuts. Remember, it was only a couple of months ago we were looking at rates to peak by about May and then rate cuts to come for the second half of next year. None of that being priced in anymore. Let's go wind back to what I had in here. So, what was the tail of the tape last week? Well, we know stocks got smashed, right? Not just US, Europe and Asia. US yields moved significantly higher. Scroll down to the charts and you can see we smashed up through the yield chart in here. If I go take a look at, where are we here? United States bond yield in here. And we go take a look where we are. Oh, where are we? Look at the candles in here. And there was a boom. Yeah, there's that smashing high that we saw in here. And we go to the daily chart in there. There we go. Last week, smashed higher and pushing back higher again in here, the 10-year bond yield. In here, pushing still higher again this morning. So bonds going to higher yields, selling off and going to higher yields. Okay, so a massive negative in here, and that's obviously exacerbating the fact that we've got dollar strength, and you see the dollar strength in here. Dollar index surged massively higher. We'll come to that shortly. Dollar yen intervention last week, but it hasn't really stopped it. And then the pound got crushed. Gold down as well last week. Gold down with dollar strength. Oil down with dollar strength, and even copper sold off, and copper's been a bit sideways now, copper going lower. So that was the tail of the tape. What we got coming up this week, where it's actually a relatively quiet week, we did get Powell is speaking on Tuesday, and also get the Bank of Japan meeting minutes. Nothing really expected from the meeting minutes. Powell is going to be speaking Tuesday. That's going to be important to watch. What do we have coming up for the week? Well, we've already had the German IFO survey. That was the main data today. Tomorrow we get US durable goods. Okay, Powell is speaking then. I think I've got this. Actually, I don't think that is. I think that's on Wednesday. We'll come back to this in a second. But I put Tuesday. I think Powell speaks Wednesday. Then we get German CPI on Thursday, US GDP and PCE, and further PCE data Thursday, Friday. And then we get UK GDP and German retail sales. So really the focus in this week, US durable goods, GDP and PCE are the standout data points we're going to be watching going through Tuesday, and then Powell speaking through the middle of the week. Let me just double check in here on Powell. I've got in there that he's speaking. I thought I put Tuesday and Wednesday, but I think he's speaking Wednesday. I'm pretty sure it's Wednesday. Yeah, we get the monetary policy meeting minutes on Wednesday, and then Powell speaks on Wednesday. So it's Powell speaking on Wednesday. We do get Bullard tomorrow, but yeah, Powell speaks Wednesday. So we'd certainly be watching out for that. Right, let's go take a look at some of the charts in here. So I'm going to start away from the stocks in here at the moment, and we'll just have a quick nod to what's going on everywhere else, and just look at that kind of those aggressive moves that we're seeing in here. Here's the dollar on the daily. So there's that surge at the end of last week and a surge again, but we have seen a correction in here this morning. So there's a potential this is a turning point day today, right? That's potentially a shooting star pattern. And you're going to see the same on the pound, right? There's a strong hammer pattern on the pound. Some of them are signaling turning points. Are they the lows in? Probably not right now, okay? There's probably worse to come still yet, but we did see, that flash crash this morning. And then what are we seeing elsewhere? Well, treasuries, we spoke about treasuries going to higher yields. So higher yields equals lower prices. So there we flashed down lower on Friday and did get a bounce, but look back on Friday's low yield levels. Low price equals high yield levels already this morning, back down sitting near Friday's lows. Let's take a quick nod to the commodity markets. We'll start off with gold. And see gold lower on Friday and lower again in here this morning. No surprises there with dollar strength. For me, gold's going to stay negative. I can't be anything but negative with the dollar the way it's going, right? So look, another sell-off. We had this kind of consolidation range in here. The market kind of whipsawed, tried to get out of that. That was back on the Fed on Wednesday, and then failed miserably at the end of last week. Again, lower this morning, tried to rebound, and you can see, look, a bit of a dead cat bounce and rolling back lower. For me, gold's still negative going into the day. And if we go and take a look at oil here on the daily, oil down, big sell-off on Friday, going through lows in here. We'd already broken through the lows here, but then going back through those lows on Friday, and then no recovery effort in here this morning, down lower again this morning. And if we step to oil on the, stay here. Whoop. Sorry. And then oil on the 30-minute chart, you can see there's Friday, then further lower in here this morning. And then again, look, dead cat bounce, can't really bounce. Consolidating for me, all the threat lower in here again for oil. So it's really difficult to play the contrarian in here at the moment with these markets and actually take the opposite side for me. It's risk off. And if we go in here, it's just, obviously no surprise for the stocks in here. NASDAQ smashed on Friday, sitting in the lower end of that range, just holding above the low in here. Okay, so that's going to be really important to watch that low. That low there from June is 11,135. Okay, we held there on Friday. Low is 11,229. We're back having another look in here this morning. So we've been down there, kind of rebounded again, tried another rebound and failed again. I can only play from the short side. Now, if you do want a contrary trade, I wouldn't even think about it until you've got this kind of this tentative trend line runs through here. It's kind of already been flirting with it recently. I think basically the more recent low, you've either got the more recent high. I wouldn't even think about going long until we go through the high that we had already in this bounce this morning. So that's 11,421.75. But really that swing high there, I think until it gets above 11,482, that high there, I don't think I would even think about, and that's from back on Friday, unless it's 11,482 minimally the market needs on the upside. If you look at the S&P, same kind of story, just held the low from over here from June. The low there, 36.57, held on Friday, 36.60 and a quarter. And again today, bit of a dead cat bounce. Again, I can only play from the short side for me, failing. You either had this trigger here, the recent rebound, the overnight rebound here that we had, that high there, 37.17 and a half. But realistically, I think this Friday swing, I wouldn't even really want to go long until we got above here. So there, 37.39 and a half. I'll be playing it always from the short side until it gets above really that one. But if it does get above here, it could quite quickly pop. Say that high there, sorry, 37.18 and a quarter, the high here from this recent bounce on the overnight. So yeah, it's all about risk off for me, which is stocks down, dollar up, bonds lower, and commodities lower. From those sides, unless we start getting above even some of these minor levels, it all looks very, 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 very negative for everything apart from the dollar. I'm going to wrap it up there, guys. I'm going to wish you all a great trading day. Please do stay safe. Have a good one. And I'll be back with you with another bull versus bear webinar on Tuesday.